Good morning, everyone. Welcome to the Baby Boomer Investing Show. I'm Kathy Tarochione. This is Ron Surz, and we have Larry with us. Ron, you want to explain who Larry is and about the show today?
Sure. Morning, Kath. How are you? Morning, Larry.
Morning.
So first of all, Larry, thanks for joining us. Larry is a professor, but most of all, a well-written, versed economist. And I've quoted him on many of our shows, but it's really an honor to have him on this show. But I'd like to leave this off by just telling our viewers that they have some choices as baby boomers about what they want to watch. But this is the only show about investing. The other baby boomer shows are helping baby boomers spend their money, which is great. But our one underlying theme throughout in all 24 episodes has been that the number one thing baby boomers should be doing now is protect their savings. Because at this stage in your life, if you lose those savings, they're not going to come back. They're highly unlikely to come back. So we've been all about warning boomers to protect themselves. And this has really probably never been a worse time to retire. Interest rates have never been lower. Stock prices have never been higher. Money printing is running out of control. So today we're going to focus on what I've said in the past is what could break the whole house of cards. And that is if interest rates go up, as they would if we get serious inflation, we're going to have some serious problems. So let me introduce Larry. If you want to go to the second slide, Kath.
Oh, all right. Okay. This is Larry.
Oh, there's Larry.
Everybody.
We have a slide to introduce you. I guess we just talk, but
There we go.
not that one. The next one, Kath.
Okay.
So Professor Kotlikoff is a professor at Boston University, and he's also president of societies and has won awards for his writing. And we're going to show you his website at the end, but it's pretty easy to remember. It's kotlikoff.net. You might have trouble spelling Kotlikoff, but the browser will figure it out. And if you go there, you're going to find articles and webinars, and it's just a treasure trove of things that are really valuable and insightful. So I encourage you to visit that. And then, Larry, you wanted to tell us why you agreed to do the show, because I think these are important things to you. So if you'd share with us your concerns.
Well, I've been focused on household personal finance since graduate school. I wrote my thesis on issues about Social Security and bequests and saving and life insurance, and over time I did a lot of research in my early years as an economist on those topics like the adequacy of life insurance, the adequacy of saving, and the future of the solvency of the country, generational accounting, how much of a burden are we leaving from all different sources onto the backs of our kids, all these things at the same time as working on more conventional economic issues about taxes and growth and even international issues. Now I work on things I work on carbon taxation and many other topics, but inequality and marginal taxes, incentives to work, and how bad they're getting. We're currently talking about adding a benefit for young children that's going to be phased out, but as you earn more money, you lose this benefit. It becomes like an effective tax on working. So if we add up all these taxes from the 30 different welfare programs or benefit programs we have in the country, how high is the marginal, plus all the taxes, how high is the disincentive to work? It turns out it's very, very high for the poor. Something like a quarter of the poor are facing marginal taxes above 75%. So 70%. So we're locking lots of poor people into poverty. So anyway, I worked on personal finance, and I developed a software company starting in the early 90s, which has developed a tool called Maxify Planner, maxify.com. And it helps people with their personal finances according to what economics is. Because I was struck by the huge disconnect between conventional financial planning, what you are told when you go see a financial advisor, or when you buy financial software out there, versus what economics says we should do. It's almost completely distinct and separate. So, and wrong. I would say that all the advice that conventional financial planning is providing is more or less 100% wrong, well, from the perspective of economics, from economic sciences perspective. So I write a lot about this. I've written about a book about Social Security with co-authors, became the New York Times bestseller. It's called Get What's Yours, The Secrets to Maxing Out Your Social Security, because there are moves you can make on Social Security and retirement accounts, on how long you work, on housing decisions, that can materially raise your living standard and rescue your retirement. Ron, you started out saying this is probably the worst time for anybody to retire. I agree 100%. My first advice would be not to retire, that people should keep working, because retirement is the surest way to lose money compared to the alternative. It's also putting you at grave risk, because if you need money, you have no way to keep making it, to get it back. And if you lose money on the market or wherever you've invested, same thing. So the software can help one think through that. But anyway, so I've been long involved in personal finance, and I'm delighted to be on your show and discussing not just our personal economies, but our national economy and our international economy, because at the national level, we are entirely broke beyond belief, broke beyond understanding, and that is gradually taking us down a path of becoming Argentina. Just one last thing on that. Argentina at the beginning of last century was the fifth highest per capita GDP country in the world. It was, a top performing country, a very high living standard. They spent 100 years screwing up that economy. The government did, by engaging in take as you go. Let's take from young people and give to old people. Let's disincentivize people from working with a zillion different uncoordinated programs, each of which adds an extra layer of taxation on working. Give people little incentive to work, and bingo, you end up 100 years later with Argentina being a developing country and a poor country, and far apart from where the U.S. is, and trying to get back to where it was. But it's kind of stuck forever in this hole, because they're forever kind of in a Ponzi scheme where they have to take from the young to give to the old, because they promised the current old, when they were young, that the money they were expropriating from them, they would be able to expropriate their kids.
Yep.
So the game of steal from your children forever, that's taken Argentina down to a permanent sinkhole. And that's where we're headed unless we reverse course.
Yeah. We need to learn that. That's a good lesson. Yep.
Yeah.
Right.
Yeah, that's a good introduction. It reminds me of, Catherine, remember when we started the show? That we started explicitly because I really believe, as I think you just said, Larry, baby boomers are getting really bad investment advice.
Yeah.
And 60-40 is a reasonable answer for younger people, but not for people in retirement. Stay the course and buy the dip is absolutely nonsense. But that's the kind of advice that I think most of the boomers are getting. And there's never been 78 million people all in the risk zone at the same time. So it's an interesting time. So
yeah, and I wanted to add to that too, that Larry, you might not know that I'm the novice here. I'm the baby boomer that doesn't know a thing about financing. So that's why, our finances, when Ron and I decided we were going to do this show, it was like him talking to a 2-year-old, so that in order for me to learn about what it is that I did wrong in my life, and why
you're doing fine.
Yeah, well,
most of our listeners know now Kathy's my sister, so
yeah,
but you're smart, but not as most people are not so smart in financial matters. That's the way it is.
But I want to tell all
Yeah.
the viewers that over the last year, I have learned so much, and I'm actually really regretful that I didn't do a lot of the things that I should have done in my lifetime. And I'm sure many of you are thinking the same thing right now, but there is an opportunity to make a change no matter what.
Yeah,
So,
absolutely.
You can definitely rescue your retirement, and I don't think it's like somebody being smart versus not smart. I think we're all smart. I think we just have different. We have access to different information, and for example, if you go to Social Security, I'm a bit of an expert on Social Security because I had to learn Social Security from beginning to end in order to put it into our software and to talk to our engineers to make sure everything was exactly right. And now we have people that are much more even, knowledgeable about Social Security than I am, former Social Security experts that work with Social Security on the team. But that system has 2,728 rules about 12 basic benefits. And then its program operating manual system has hundreds of thousands of rules about those 2,728 rules.
Wow.
So you could spend literally your lifetime learning the provisions of Social Security. Our company, we started back 28 years ago. It's taken us years to get Social Security exactly right because it's that complicated. And these rule books are very cryptic. They have their own language, and they're most often incorrect. We've come up with things that we said, look, to the Social Security actuaries, this provision in your rule book contradicts that provision. You have to fix it. So we've actually, on several occasions, corrected Social Security provisions for them or with them. And so they listen to us when we call them and talk to them about what's going on. But the main thing with Social Security is it's the first or second largest financial asset for most people. I'm talking about probably 60-70% of households. So you have to think about managing that asset because that's something that's independent of the stock market, independent of the bond market, inflation, independent of what the government's doing. It's a place where you can make a lot of money by doing something perfectly safe and simple, which for most people is this simple thing, which is just wait till 70 to collect your retirement benefit. That's not true for everybody, but for most people, waiting till 70 to take their retirement benefit. It's not true for widows, for sure. For many widows, taking a retirement benefit early, taking a widow's benefit later is better. But we're just talking about, if you're a single person and you've got a maximum age of life, you could live to 100 or 90, wait till 70, figure out what you can do, move heaven or earth to wait till 70, borrow from your brother, keep working, cash in your retirement account money, because your benefit is going to be 76% higher adjusted for inflation. Sorry, I've got my cat here talking to me.
I was just going to say, feed
I was
that
wondering
cat.
where that was. Yeah.
Feed that cat.
Yeah.
That's Riley, and he wants to go out, but
So Social Security, I think, is just maybe something we can spend a whole show on. This show is about the debt, so I think we need to move on.
Well, Social Security is a good. Here, sit here, Riley. The Social Security is a good entree into the debt issue because Social Security by itself has been run as a Ponzi scheme, as a separate take from the young, give to the old.
Right.
And now, if you look at the last April's Social Security Trustees report, and you look at table 6F1, which is numeral Roman 6, so V1, there's VI number 6, no, a VI, which is 6,
Yeah.
letter F1. Go to that table in the report. They hide it way in the back, that in the appendix, and you'll see that Social Security's unfunded liability, their debt, which is no real different from official government debt, is $53 trillion.
Wow, we're going to use a smaller. I use a smaller number in talking about your work. So that's twice the size I use. So we're going to come to a slide on that. But
the GDP, the country is producing about $21 trillion in output. So we're talking about 2.5 years of output, and that debt has gone up by about 10 trillion just in 1 year. because they changed their assumptions about how to calculate it. And whether it's 53 trillion or 43 trillion or even 30 trillion, it's a huge number. And
slip two slides. Just because we have a slide on this, Larry. I just don't want to forget it. So we're going to skip the next slide.
Okay, let me bring that up.
That doesn't count the. Yeah, go ahead, Ron. Tell us about this one.
No, we're going to skip that one because you're on this slide. So over on the right-hand side here, I read, well, several of your articles on Seeking Alpha, but one of your first ones was, is the U.S. bankrupt? And then not too long after that, you wrote an article that says, U.S. is dead broke. And the numbers from those articles are over on the right-hand side. So the gross domestic product is 21 trillion. The official debt, I just looked it up today, it's $1 trillion higher now. It's 28 trillion. But in those articles, you were saying the fiscal shortfall, off-balance sheet debt is what you called it, was 29 trillion. Now you're saying it's north of 50. It's just incredible.
Well, that's just for Social Security. We're not, including Medicare, Medicaid, the obligation to pay for defense spending. What you need to do is put all the line, if you're an accountant, about double bookkeeping accounting, entry accounting. So you'd have, the country has, the federal government, Uncle Sam, has a balance sheet. And on the right-hand side is the liabilities. It owes these benefits, Social Security benefits, Medicare benefits, Medicaid benefits, welfare benefits, defense spending through time, paying for the president's lunch, gassing up Air Force One. The whole path of those has a value in the present, and then it's called the present value. And then the whole path of all the assets, namely most of which are the tax revenues,
tax receipts, and then we have some other assets like the value of our government ownership of Amtrak, to partial ownership of Amtrak. So if you look at the two together, the liabilities exceed the assets. That's what we call the fiscal gap in economics, by about $160 trillion. That's about 8 years of GDP. That's the latest number. And that's including everything. So that's putting everything on the books. And so it's about 200 trillion now, not 103 trillion. I need to update my numbers.
Trillion is my latest number, about 8 years of GDP. I think we're the most fiscally insolvent country, we've got the worst fiscal position of any developed country.
Worse than Japan?
Worse than Japan.
Wow.
Because Japan, for example, has a pension system where they have reformed it, and they don't have healthcare. They don't have a healthcare system where the prices are going out of control, where the expenditure is getting bigger and bigger every year as a share of GDP. And the CBO is projecting this. I'm not coming up with my own numbers. I'm using the Congressional Budget Office's projections and just extending them. And here's what it says. Now, the other key thing that people need to realize is that what is official debt and what's unofficial debt is purely a function of language. So this year, Uncle Sam, I'm working at Boston University. I'm as you said, I'm a professor and I get paid. And every month that my salary is reduced because of payroll taxes. I hope you don't mind Riley showing up, making a guest appearance.
No,
this is great. Yeah.
So the government's taking my FICA taxes, and they're saying they're taking money from me, and they're promising to give me back benefits in the future in exchange for these taxes.
Yep.
Well, they could say, look, what we're doing here is that money we're taking from you, we're borrowing. We're going to give you back. Here's an IOU. Rather than a kind of an implicit promise to future benefits, we're going to give you a treasury bond. And in the future, you'll be able to present it to us to get back money. Right now, they're recording how much I hand them as, quote, FICA taxes, and they're giving me a commitment that I can look up online for future benefits. It's just a choice of language. They're calling these taxes, this money I'm giving them, taxes as opposed to borrowing. If they called it borrowing, it would show up on the books. It's that simple. So Congress has been very clever to keep things off the books just by that little thing, that little trick. Calling something borrowing calling something taxes rather than borrowing. But it's really the true liability is what do they owe me versus what did I put in? That's what shows up in the fiscal gap accounting, because all the obligations in the future are discounted and valued in the present, and all the receipts are discounted value in the present. So we get to see, on balance, are we solvent? Do the liabilities, are they covered by the receipts? They're not. They're 160 trillion short, 8 years of GDP.
Yeah, that's even a bigger number than I thought. Yeah.
So when we talk about, a $1.9 trillion stimulus, I think we need to have a big stimulus. I think 1.9 trillion is the right number, but I don't think we should leave that bill to our kids. I think we should raise taxes on the rich right now to pay for that 1.9 trillion. Whether we should raise taxes on people like me in order to pay that, not leave the bill for my kids and your kids and everybody else's kids to cover. And how do they cover it? They cover it on a progressive basis by raising tax rates and leaving the people that are most productive in terms of producing income and taxable income having very little incentive to work. So let me just give you a real quick example here, Ron, that connects back to Social Security. So President Biden, who I think is doing, on balance, a marvelous job, and thank God, relative to the former president, who I think was more interested in his golf game than the country.
You need to be careful.
I know.
Yeah, we're going to get all kinds of feedback.
Well, there's some. All right, let me just balance that by saying. That some things, that some policies, like the Tax Cut and Jobs Act, had some good features to it, and indeed, I and other economists talked to the Ways and Means Committee. But if you ask, was Trump himself involved in the Tax Cut and Jobs Act, which basically was developed by a Democratic oriented, I'm not Democratic or Republican, just to tell you where I'm coming from politically. I think politics and economics don't mix. But I have a co-author who had a big hand in developing the basic Tax Cut and Job Acts, and he's clearly a Democrat. So this policy came from academia to a large extent. And it was passed under Trump, and he gets credit for that, rightly so. That was, I think, on balance, a good thing, but I would give it like a B-, not an A+.
Yeah, I think that a lot of these moves are spending more money, and we're going to get into that. But I mean, so today's headline, I got an email.
By the way, a B- is a good grade for me.
Okay, good. So I wouldn't want to be one of your students, but that's okay. If
you're a Trumpster and you love President Trump, which a lot of people do, I don't get it, but a lot of people do. I'm giving him a pretty high grade, B-, okay? For that. And there's some other things that happened under his administration that were positive. But
okay, we need to move on, Larry. I understand. But so can we get back to that slide, Kath, just expanding the scope?
Sure.
So the U.S. is in deep doo-doo. I expanded on your article, and you've probably done the same thing, but I reached out to other countries, and I thought Japan was worse than us, but I guess not. But the official per capita world debt is something on the order of $85,000. But if you build in sort of an estimate of this off-balance sheet debt, I come up with $200,000, but the bottom line is it's maybe $400,000 using your updated numbers. But that is spawning all sorts of things that we see every day, but not really identifying as a world debt crisis. We see for a while we had inverted yield curves. We see gold going up, inflation concerns, all of those things. So this is not
Bitcoin going up too, right?
Yeah, Bitcoin is up $50,000 now, I think, something like that. Well, we had a show on Bitcoin three episodes ago. But no, I show people this, and we get feedback, and especially on Social Security going bankrupt in 2026, which I think is now moved up to, earlier than that. And Medicare in 2034, they say, we can't go bankrupt.
I think
the government will just print money.
possible switch. I think Social Security's later in Medicare anyway, but
Oh, okay.
All
right.
I think
I should
Social
update these numbers, but yeah.
2031, where they have to cut benefits by a quarter to keep paying not have to borrow more.
Okay. 2031, 2034 for Medicare?
I think Medicare might be sooner.
I would imagine it'd be sooner if we put everybody on Medicare.
Yeah.
Yeah, right.
Again, the bookkeeping, I don't think you want to look at things kind of program by program. The fiscal gap is, you want to look at things comprehensively, because the government not only can decide what to call a debt and what to call a transfer obligation, but they can also decide what to put into this program versus that program. So it's only when you put everything together that you see the big picture, and you see the burden on being left for future generations, kids, and that's called generational accounting, which I helped develop.
That's important.
Generational inequity.
Yeah, we're really passing all this obligation on to not just our kids, but our kids' kids and their kids, and I don't know, it goes deep. Yeah. So this idea that we can just print money is on the next slide.
Sure.
And we talked about this getting ready for this, but modern monetary theory isn't modern. It's not really a theory, but it's sort of the underpinnings, I think, of what we're seeing now with the government printing money. And in the upper left side, this is not physical printing press running 24 hours a day. What really happens is the Treasury borrows money, it issues bonds, and in fairly ordinary situations, the buyers of those bonds were foreigners and our citizens and the whole list of people. But currently, most of that debt is being, quote, bought by the Federal Reserve System. So it's just being manufactured out of thin air. And then quantitative easing did about $5 trillion of that. And it didn't move the inflation CPI needle even a little bit. And everybody goes, well, see, we can do as much of that as we want because it's not causing inflation. I've gone on the limb, but I've seen other people sort of have the same view, that I think most of that money went into the stock and bond market. So it didn't move the commodity prices, but it did definitely inflate the stock and bond markets. This new COVID relief money is going to people who are going to buy groceries, and they're going to pay their bills. And that is highly likely to move the CPI needle. So that I threw all that out there and just wonder what your thoughts are on the mechanism. And
yeah, let me be a little bit clear about the mechanism. So when say I'm the Janet Yellen, I'm the Secretary of Treasury, and I need to get money that I can't get from taxes because there aren't enough taxes coming in to pay for. The president wants to have a state dinner for President Macron, and he needs money to buy caviar or whatever. Okay, so Janet sells a treasury bond to Kathy. Okay, Kathy hands her the money. Janet takes the dollars and buys the caviar, gives it to the president for dinner. Okay, now Kathy's sitting there holding the treasury bond. I'm Jerome Powell, the head of the Federal Reserve. I print up money and I hand that to Kathy for her treasury bond. Now, if you look at the whole story here, the president gets the caviar and the public has more dollar bills floating around. That's monetary finance through this kind of shell game. I mean, Janet could have just printed the money and gone off and bought the caviar from Kathy. That would have been a lot clearer. But this two-step process disguises what's happening. Now, the other thing, so anyway, got more money out there and chasing fewer goods available to the public because the government has sucked in some of the real goods and services. So there's less out there with more money chasing it. So that is inflationary pressure. And then the other thing that's going on here is that the Fed is printing money. Jerome Powell is printing money to buy the bonds, the IOUs of companies that may or may not be able to repay. They're buying, as far as I know, even junk bonds. They're very questionable bonds. So
They're saying they might even buy equities. Is that something you see the
well,
Fed doing?
we don't see them buying equities directly, but we have seen that in other countries.
Yeah, okay.
Hong Kong supported stock market. So if Jerome Powell, ABC Corp is kind of, let's say, in bad shape, they need to, nobody will lend them money. The Federal Reserve prints up some money, gives it to ABC Corp. Maybe they go on a vacation with it, just suppose, because they realize their company is hopeless. They're going to be able to repay. So Jerome Powell is expecting for them to next year or in the future hand those green dollar bills back, and they're going to hand back their IOU. The Fed will, and the money that goes out will come back in. So we won't have more money in the economy through time. In present value, we won't have extra money floating around raising prices. Now, if they can't repay, then that's another way in which we get more money sitting out there. Now, the Fed has, since 2008, really been printing a huge amount of money, and some other factors in the money market, if you like, have led to less inflation than we would have expected, because we've had prices rise since 2010 by about 20%. We've had the money supply rise by about 400%. So we have right now the basis for hyperinflation. If we just went back to the conditions, and I'll just use two technical terms, the money multiplier and the velocity. The money multiplier is the degree to which banks lend out money and help create more liquidity and in effect expand the money supply.
Yeah, so we've had no velocity. That's
the velocity is the rate at which money becomes a hot potato in your pocket.
Right.
If prices are rising very rapidly, like they were in the Weimar Republic, people got paid in wheelbarrows full of money. They were printing so much money.
Right.
And if you didn't spend it by the end of the day, you immediately took your wheelbarrow full of money.
Another wheelbarrow, yeah.
And went to buy groceries or whatever. If you didn't do that, by the end of the day, that wheelbarrow full of money would be worthless.
Yep.
So that's money moving more rapidly. Spending that money very quickly at the grocery store within an hour, that's faster money. Faster money is like more money. So most of the hyperinflations have been driven by faster money, by money speeding up, the circulation, the velocity kicking up. And that can happen overnight. If people get it in their head that prices are rising, then they could start saying, if they think that we're going to have inflation, they start getting rid of the money, trying to make it a hot potato or making a hot potato. And then prices actually do rise, and it becomes, again, a self-fulfilling prophecy. And you said, Ron, that we haven't seen inflation. I would say we have seen inflation, but it's hard to see it because has the Fed not intervened?
I said the same thing. It's hard to see it because you're looking at commodity prices, and I think it's been in security prices.
No, I wouldn't say it that way. I don't think.
All right.
I wouldn't call it.
I'll agree to disagree, but go ahead.
Yeah, I wouldn't call price increases in the stock market inflation. We're really talking about goods and services going up in price. But if you think about the counterfactual, inflation is always relative to some other path of prices. Had the Fed not intervened starting in March, we would have seen a deflation like we saw in the early 30s, probably a very significant one.
Yeah, there's a lot of deflation.
So relative to that, we've had inflation. So the modern monetary theorists who say that printing all this money hasn't had any impact, well, it's kept prices from dropping dramatically. It's kept the financial system from collapsing. And so it has had a big impact. And it's cost people. You know, if prices had dropped, and Kathy here is holding treasury bonds, she would have experienced a real capital gain, or the money in her bank account, if the price of a hot dog had gone from, $5 a pack of 10 hot dogs to $2 or $1, she would have had a five-fold increase in the purchasing power of her checking account money. Mm-hmm. So she was taxed, in effect, in a very subtle way, that she didn't get this increase in the purchasing power of her nominal assets. So it's very subtle to see the inflation that we've actually had happen. It's prices stayed the same, but you have to realize that they would otherwise have crashed, and that they stayed the same because of the intervention, because of the extra money, I think.
Yeah.
So,
Well, that speaks to the dip in March. But start the clock in 2009 and bring me up to the end of 2020. No inflation.
well, we have, the world is, think of it this way. We have a lot of competing fiat currencies, which are, currencies that have, these are pieces of paper, right?
No, I know. Yeah, that's the problem with fiat money.
Okay, I think it's illegal to do this. I'm going to do this anyway.
Oh, don't tear it.
But you can tape it together and still be. So I will tape it together. Usually, when I do this in class, this is to remind people this is money. Okay.
But now you got twice as much.
Yeah. So if you think about the fiat currencies around the world, they're competing, and if people don't need to have more than one means of exchange. So if you thought about it, in the early part of our country, we had every bank was issuing their own currency, and in the 30s, we had something like 3,000 different municipalities issue currency. Some of it was in the form of tree bark, which was like, they would write an amount of money on the
tree bark.
Tree bark, and that would circulate as money. So it can very easily be the case that some people, stop using these currencies and start using this currency. And when there's a bigger demand for currency, the prices go down, or the prices don't go up by as much. So part of what may be going on here since 2009 is a much bigger demand for the dollar.
Because it's the trade currencies, and the world's trade currencies.
Yeah. We also know that about 40% of U.S. Treasury bonds are held by foreigners. So they're also keeping our interest rates low. So there's a lot of confidence in the U.S. and maybe misplaced confidence. I don't know how many people know that we're 8 years in debt. A handful of people probably in the street know this, let alone around the world. They think the U.S. is like Switzerland, but it's not like Switzerland because we're not like the Swiss. We're not careful, big savers. We're not like the Chinese. So as soon as people understand that this is like the end of the Confederacy, think about here you have this stable currency, the Confederate dollar, and every year it becomes less stable. And as it becomes clear the North is going to win, it becomes something that's not even worth the paper it's printed on in terms of what it can buy.
Yep.
And you use it to light fires. Same thing happened, ain't worth a continental. Remember that expression?
Yeah.
Same thing.
That was when the dollar was backed by with silver or gold or both. I don't know.
Well, they backed it, but everybody knew they didn't have the ability to collect the gold to back up the continentals that they were printing.
Yeah.
So by the end of the year, end of the Revolutionary War, the continentals were not worth ain't worth a continental. So this is. I had a friend.
That was the good old days when the dollar was backed by something. It hasn't been backed by anything since the 70s, right?
When I was a young grad student, I went to work for the Federal Reserve for the summer, and I had a friend, Michael Dooley, who was a senior economist there. And I walked into his office. Wall to wall, it's covered with defaulted bonds and currencies that were of no value. I mean, he had every single defaulted bond and worthless currency just covering his walls. So that can happen to the U.S. dollar too, and it can happen quickly. So your concern about that is is appropriate. If you're asking me, how do baby boomers deal with this very unsafe retirement? I would say number one is don't retire. Retirement is the surest way to lose money, and it's one of the riskiest things you can do. I would say make sure you maximize your Social Security. I would say make sure you take your retirement account money out at times where you can lower your average tax bracket. So use Roth conversions and time the withdrawals and decide whether or not to take the Roth money out first or second that you already have. I would say downsize your home, move to a state where there's no low income taxes. So in our software, you can do all this stuff. And I've taken typical middle class households who are, 62, think about retiring, and able to increase their living standard for the rest of their life up through 100 by 50%, just by doing that handful of things, none of which involve going into the stock market. So this is what the finance community calls getting alpha, seeking alpha, or finding alpha. Alpha is like the safe return. Beta is referencing the risky return. The stock market right now, a lot of people think is extremely overvalued and is in for a crash. And it really depends in large part on the Fed and how long people believe that the Fed's going to be able to keep interest rates low, and whether people are thinking that the stream of dividend payments that the stocks are issuing should be discounted at these very low and even negative, if you're talking about inflation index or safe rates, very low real rates. If you discount something at a zero rate, or it can be a very big number.
Right.
So that may be what's underlying the stock market valuations. People believe that
that's one that the investment managers are saying, and I have two reactions to that. I just wonder what you think. One is I did that exercise. I started with interest rates in 2008, right. And they've come down since then.
Riley here,
and I lowered the discount rate.
Yeah,
and my estimate is that based on just lowering the discount rate, stock prices should have increased by 50%. That's a big number, 50%. But stock prices are up 400%.
Well, so here's the thing, Ron. You should not be discounting a stock. You should be discounting stock returns or the dividends, the payout at the risk-adjusted discount rate. But if the Fed is taking the downside of a corporation, it's saying we're not going to let corporations fail.
So you think the discount rate should be negative or zero?
No, then it becomes an uber safe asset. So now you go from discounting it at the safe rate plus a risk premium to discounting at maybe just the safe rate, or discounting at a safe rate with even a negative risk premium, because there's negative risk here. There's no risk. It's not like there's no risk. There's negative risk.
Well, here's my point in a nutshell. I don't think that discount rate reduction should cause stock prices to quadruple. My best estimate is 50% increase, but quadrupling is really giving a lot of credit to the discount rate.
Well, I think it's, it could be a bubble. It could be euphoria. It could be.
I think it is a bubble. And the other point is
that it can also be the Fed's policy of saying we're going to maintain these zombie companies. A lot of companies are zombies.
That's another reason, but not the discount rate reason, I don't think. And then there's a whole litany of reasons. There's FOMO, fear of missing out. There's what I call hopium, where I think the millennials are taking this drug that makes them think everything's going to be wonderful. There's a whole litany of things that bring it up. But the discount rate thing, I would argue, is already baked in. So unless you think interest rates are going to go significantly below zero, it's pretty hard to believe that the discount rate thing is the justification.
Why should the market still be going up?
Managers are justifying the current prices by saying discount rates have never been lower, and I think we're being gaslighted. That's what I think.
I think the Fed. Well, let me agree with you in on a different angle, but I agree that, my argument doesn't really explain the recent increase, like even over the last couple of weeks, increase in the market. So what could be going on here? People might be saying, look, this is the only way I can get a return because after inflation, I'm getting a negative return if I put it in long-term in bonds. And, but we haven't seen, if people were afraid of bonds or didn't want bonds, we would see the interest rates shoot up more rapidly than they have. They've increased a bit, the long-term rates.
Mm-hmm.
So maybe you're absolutely right. Maybe it is just irrational exuberance of the kind that Alan Greenspan referred to.
Well, the whole list isn't irrational. It's understandable. So FOMO, fear of missing out, I don't know if that's irrational. That's greed. Hopium is, no, the millennials didn't see 2008. As far as they know, the markets only go up. All those things are, I think, in bringing stock prices up. Kat, I think we need to stick to the slide that says regardless of who is right. Because I want to give Larry a chance to tell us about all his webinars. So after that,
the next one.
After that, I think 2 more. Yeah,
One
after
more?
that one. Yep. Thanks, Kath.
Okay.
No, 1 more. I'm sorry.
Okay.
2 more. we're going. That's it.
Okay.
So I like this slide because I came across this cartoon in the upper left. Did you recognize who that person is, Larry?
Yeah.
Who is that person?
It's this Alfred E. Newman from Mad Magazine.
Oh.
And the caption would always be, "What, me worry?" It was just a classic Mad Magazine.
Oh, that's Alfred R. Newman, or Alfred E. Newman.
Yeah.
Who's the guy on the right?
The guy on the right is a baby boomer saying, so the guy on the left is a Wizard of Wall Street. And he's dressed like Harry Potter, going, "Don't worry because everything's going to be glorious." And the guy on the right is a baby boomer saying, "Yeah, that's my money. I want to keep it."
Right.
So our theme for basically all of these shows has been, and I think you just said it too, Larry, there's smarter ways to protect your savings. And it's not smart at all to follow the kind of advice that we're pretty sure boomers are getting. So the data says that the average boomer is 60-40 stocks bonds. And when the stock market went down in March, everybody read, and including me, everybody was saying, stay the course, buy the dip, it's all going to be okay. The only point I want to make on this slide is for the boomers who are watching this, you really need to be careful. You really need to recognize that if you lose your savings now, you won't get them back. It's
no coming back.
Not coming back. So Larry, on the next slide, I'd like you to tell us some of your webinars, and you have one a week from tomorrow on reverse mortgages.
Yeah. So if you go to this website, which is basically maxify.com or maxifyplanner.com, and you click on for households or for planners, you'll see a link to our webinar page. I've done a bunch of webinars and had a financial planner who's using our software, who's also an economist, Rick Miller, do a couple on all kinds of topics: retirement accounts, Social Security, housing, career choice. And next week on Wednesday, we're going to, at 2:00, have a webinar on reverse mortgages, and that's open to the public. Just sign up. And we post all the webinars on that same page.
Yeah, it's a nice website. That's good.
We record
a lot of good topics and good advice.
There are just a whole lot of ways you can rescue your retirement. And just on the investment side, one thing you can do there is to say, look, I can invest in, take money that I'm willing to lose or prepared to lose and put it into the market or into risky investments that I think maybe are not going to move with the market, but are still good investments. Maybe I know something about these companies, or somebody I really trust knows something, has done their homework on these companies. and they're going to be good investments in the long term. Maybe like GM, which seems to be up and coming in the electric vehicle market. And that's money you're prepared. That's your casino money. That's the money you're putting at risk. And the rest of your money you invest, of your savings, you invest in inflation index bonds, even absorbing a small negative return, or I bonds, which I just wrote about. If you go to kotlikoff.net, which is my website, and click on columns, you'll see an article in Forbes about I bonds.
Is there still a limit on how much you can buy of I bonds? I thought
I think 10,000 a year, but you can buy
Yeah.
one. You can buy 10,000 for each family member. So if you've got 3 kids, and
Okay.
a husband, wife, we're talking about 50,000 a year.
Yeah, those are nice.
And yeah, they guarantee a 0 real return, so you can keep your money safe. So you build a living standard floor using our software, based on maybe I bonds and investing in tips, and then you take money that you want to gamble with, put it in the risky investments, whether it's Bitcoin or gold or the stock market, and then don't spend out of that at all. Just kind of forget about it. I mean, watch it, figure out how you want to invest it, but don't spend out of it until you convert it to safe assets. And then you can raise your living standard permanently based on what you've taken and made safe. That's called upside investing. That's generating a living standard floor and just having upside risk relative to that living standard floor. That's something that anybody can do on their own. And it's what economics would suggest for middle-class people and boomers who are nervous or risk averse, that this is the way to safely proceed and not experience a decline in your living standard, because that's what we're all worried about. We don't want to be
Exactly.
suffering a big drop as we get older. So I think that economics brings a lot to the table. This software, Maxify.com, can really help you dramatically with your retirement planning and rescue your retirement to a large extent.
That's great. So we always conclude with the last slide, and I just want to remind our listeners that we're here to help, and Larry's here to help. And he has his websites, we've got ours, but if you want to support us, we're on Patreon. So if you can get this show on SlideShare. If you click there, you can sign on to support us. We're not asking for money, but what you could do is like us and follow us on Facebook and YouTube. We have some websites. We have a self-help website called 8-Stage Robo. We have a website where you can get an advisor. It's called GlidePath Wealth Management. Certainly know the Baby Boomer Investing Show. And we manage target date funds in a collective investment trust called Smart Funds. So that's the only commercial you're going to get. And if the spirit of that is we're here to help you, and Larry's here to help you. Please get in touch with your current risk exposure. If you're like the average boomer, you're 60% equities, 40% bonds. If you're getting the kind of advice. So one of our third episode is a history of financial consulting, the last 70-year history. And just one of the things to be aware of, in the original days when the advisor was trained to help you determine your risk tolerance, the word tolerance was take as much as the client can possibly stand, because risk gets rewarded over the long run. And that was at a time when we didn't have 78 million baby boomers. And that advice is probably reasonably good for the millennials and certainly younger people, but not so good for people who are nearing the end of their life. And that's where we are.
And also, even over the long run, there's no evidence that the stock market is safer. There's this apocryphal view that if you invest for the long
Jeremy
term,
Siegel.
Right. Jeremy, who I know. But if you look at Zvi Bodhi's work, if you just look at the markets, if you're trying to buy insurance in the form of put options,
right, you can't buy it.
For protecting you against the market declining, they become more expensive, properly measured, the further out you go.
Sure.
so actually risk about the stock market is bigger the further out. So this idea that for sure, even though in the past people have done well over 30-year holding periods, it's not the case in the market that you can, buy insurance against the downside 30 years out at a cheaper price than out 2 years.
Exactly. That's a great
Much
point.
more expensive.
Yeah.
Indeed, the market doesn't even exist, I don't think.
Yeah.
So you really can't count on that. What you can count on is the fact that Social Security is paying you 76% more adjusted for inflation starting at age 70 if you wait to get your retirement benefit than starting at age 62. And only 2% of American households, workers, are waiting till 70. Almost everybody's doing a really bad job on optimizing this most important or second most important financial asset.
Yeah.
So that's an example of something that can mean hundreds of thousands of dollars for a middle-class household, for the baby boomers retiring today and trying to figure out what to do.
That's right. Yeah.
Yeah. And the software will show you that. It'll show you, hey, do it this way or do it this way. In present value, your lifetime spending is going to be this much bigger. And that's the power of economics. So we have a lot to bring to the table. We're not here just to kind of sell. I'm not here to sell a product. I'm here to help people. I don't actually even get paid for I've had my company for 28 years. I don't get paid from my company. I don't make money on my company, period. Because it's purely like a charitable.
You have to laugh because I'm not getting paid either.
Maybe at some point it'll be big enough.
Yeah.
To draw a salary.
Yeah. None of us are getting paid.
Yeah.
It's a shame.
I don't want to throw water on the fire here, but one of the reasons I think that people are retiring earlier is because there's such a scare that Social Security is going to go bankrupt that they're not going to get theirs.
Yeah, and Larry, I think you even mentioned there's a way for the government to save Social Security, but you really, I can't even remember what you suggested, but it was pretty radical. I don't know.
Kathy, you're absolutely right. I mean, the system's $53 trillion in the red.
Yeah.
According to them. But the question is, would they cut the benefits for people that are receiving?
Yeah.
I think they would probably more likely default on government bonds because a large share of them are owned by foreigners before they cut Social Security benefits. I just don't see this politically happening.
Great.
So I think if you're pretty close to retirement, I can see them taxing benefits at a higher level, and that's just getting at you another way. So that is a risk. But you might as well have a 76% higher number that's being taxed at a higher rate than a smaller number, right?
Yeah. Well, I think that fear that people like I would have is I don't want fear of missing out. If I don't take it now, I could be losing it later on.
Yeah.
And maybe we need to let people know, just like you said, Larry, that that's not really going to be the case. It will be there for you.
Right. It will be there. And a lot of people are taking their benefit early because they think if they die, they're going to have lost their benefit. They work their whole life. They die. What a tragedy. But if you die, you're going to be in heaven. You're not going to be kicking yourself for not taking your Social Security.
Yeah. Right.
But you can just,
I'm taking mine.
You just see yourself looking down and going, damn, I should have taken it early.
If you take it early, you're going to lower the survivor benefit to your disabled children, to your spouse, to your ex-spouse. So the benefit for survivors, for widowers, is higher.
That's a good point.
If you wait till 70. Now, this thing's very complicated. Not everybody, if you earn too much relative to your spouse, you're not going to get any widow's benefit no matter when they die, because you're just going to collect a benefit that's higher on your own. So it's complicated. The software will figure it all out for you.
Yeah.
We've been at it for 28 years getting it right.
Okay, what a great show, you guys.
Great. Thanks, Larry.
Great show. So we're going to end the show with we'll see you in a couple of weeks. And Ron, do you want to say what our next show is going to be about, or do we know?
It's the magic of getting rich. And I'm only saying that because I have no idea what the next show is going to be, but
okay,
maybe with that theme we'll get a lot of viewers.
Okay. All right, everyone. Thanks for watching.
Yeah, thanks.
Thanks for having us.